What if I told you the biggest opportunity of your financial life just happened and almost nobody noticed? Not the media, not the average investor, and not even most financial YouTubers, but one ETF did. And it made a move so bold, so perfectly timed, that it almost doesn't seem real. They loaded up on energy stocks right before Trump's $4.5 trillion big beautiful bill passed. A bill that, for once, doesn't just talk about change, it rewires how money flows across industries. And here's the kicker. While everyone's obsessed with tax cuts, they're missing the real game. A government-backed sector shift so powerful it could turn ordinary dividend portfolios into passive income machines. But only if you're holding the right ticker. Now, I'll be honest with you. A few years ago, I was the guy clinging to safe ETFs, the slow and steady types. I thought I was playing it smart, but in reality, I was playing small, missing out on the real compounding power that comes when policy, cash flow, and smart rebalancing collide. Today, I'm breaking it all down. No fluff, no guessing. Just what changed, why it matters, and how you can ride the wave that the smart money is already quietly surfing. If you're between 25 and 50 and you've ever wondered how the wealthy seem to always get ahead, while everyone else is stuck reacting, this video is your wake-up call. Stick with me, because by the end, you won't just understand what's happening, you'll know exactly how to act on it. The billion-dollar mistake most dividend investors are still making. Here's the trap, and trust me, I fell into it too. When most people think of dividend investing, they picture something safe, predictable, slow but steady. Maybe that's how your parents did it. Buy a few ETFs, hold forever, and collect checks while you sip iced tea in retirement. But that playbook, it's outdated. And in 2025, it's getting punished. Because while investors are celebrating tax cuts like they just got a stimulus check, the smart money isn't chasing headlines. It's tracking policy flow. And right now, the real game is being played one level deeper, where trillion-dollar shifts in sector exposure are creating silent winners and silent losers. Here's the mistake. People think tax cuts are equal opportunity, that they'll float all stocks, growth, value, tech, healthcare, but they won't. This new legislation doesn't just reduce taxes, it redistributes momentum. And unless your dividend portfolio is aligned with the sectors getting that momentum boost, you're holding dead weight. Let's be clear, this isn't just about making a few extra bucks. It's about choosing between a portfolio that compounds quietly and one that explodes. The difference isn't theoretical, it's happening right now. And it all comes down to one number, 19.4%, the number that changes everything. When I first saw it, I thought it was a typo. One ETF, just one, made a massive allocation move right before this bill passed. It shifted its portfolio to hold 19.4% in energy stocks. To give you context, most dividend ETFs hold maybe 3 to 8% in energy. That's typical. Safe, boring, but this one fund, SCHD, made a bet. A big one, right before legislation that poured fuel on the entire domestic oil and gas sector. Coincidence? Let me spell this out. The bill mandates massive expansion in U.S. energy production, rolls back renewable subsidies, restores 100% expensing on new factories, and unlocks billions in incentives for industrial growth. Translation? Energy just became the government's favorite cash engine, and SCHD knew it. That 19.4% isn't just a number, it's an early stake in what could be the most profitable dividend sector of the decade. While everyone else was asleep at the wheel, this ETF quietly loaded up. Right before energy stocks got handed the keys to the treasury, companies like ConocoPhillips and Chevron didn't just survive, they were set up to thrive. Think about it. That's like buying beachfront real estate the week before they announce a billion-dollar resort is being built next door. Now here's the wild part. This rebalancing happened in March 2025, before the bill was finalized. Which raises a huge question. Was this brilliant timing or brilliant foresight? Either way, it changes the game. Because this isn't just passive income anymore, like it's proactive positioning. And the investors who recognize that shift early, they're not just collecting dividends, they're building wealth with policy as their tailwind. What Trump's 2025 Big Beautiful Bill actually means. Let's cut through the noise. Trump's Big Beautiful Bill isn't just another round of tax cuts. It's a full-blown economic rewiring. a massive policy pivot that will shape how money flows for the next 5 to 10 years. Most people are stuck arguing politics, but smart investors, they're following the incentives. So here's what actually happened. Simplified. First, the bill makes permanent the 2017 tax cuts. That means lower taxes for individuals and businesses for the long haul. Second, it turns the dial up on business growth. The pass-through deduction for small businesses raised from 20% to 23%. Section 179 expensing doubled from $1.25 million to $2.5 million. And 100% expensing for new factories and upgrades? That's back on the table. Translation, businesses now get huge upfront tax write-offs for investing in growth. But here's the bombshell. The bill directly targets U.S. energy production, unlocking domestic oil and gas development, slashing red tape, and rolling back green energy subsidies from the Inflation Reduction Act. This isn't just pro-business, it's pro-oil, pro-industrials, pro-defense, and pro-cash flow. It's like flipping a switch and flooding certain sectors with tailwinds, all while leaving others gasping for air. Now, what does that mean for us as investors? It means this isn't the time to be passive. The people who simply buy and hold what worked last decade are going to be left behind. Yeah, because this bill creates clear winners and obvious losers. And now is the time to rebalance before the market fully prices it in. Sector shifts, winners versus losers in the new economy. This is where it gets real. Because the market doesn't reward all investors equally. It rewards those who align with where the money is going, not where it's been. Let's start with the biggest winners. Winner number 1, energy. Thanks to this bill, U.S. oil and gas firms just got a blank check. Regulatory green lights, tax write-offs, and policy priority. We're talking about companies like Chevron and ConocoPhillips, core holdings in SCHD, who now have both pricing power and production incentives. That's a dividend recipe you can't fake. Winner number 2, industrials. While everyone was focused on consumer tax refunds, the bill quietly funneled $12.5 billion into air traffic modernization, defense tech like the Golden Dome, and border infrastructure. Companies like Train Technologies and Industrial Righties quietly sitting on a future contract gold mines. Winner number 3, financials. Higher consumer spending equals more swipe volume. Visa, MasterCard, JP Morgan. All set to rake in transaction fees and margin gains from rising interest rates without added regulation. These are the hidden engines of economic velocity. But here's the twist. Not all dividend sectors were invited to the party. Loser number 1, utilities. Rising rates and the death of green subsidies? That's a double punch to utility stocks, especially those leaning into renewables. The same government that subsidized them 2 years ago just pulled the plug. Loser number 2, tech without cash flow. Yes, some tech wins from R&D expensing, but those without solid margins, they're exposed. Growth at all costs is out. Cash flow kings are in. Loser number 3, balanced dividend funds. The ones holding a little bit of everything that even the losers, they dilute the upside. They play not to lose. And right now, that's a losing game. That's what makes SCHD so dangerous. In a good way. It didn't just avoid the losers, it loaded up on the winners. And when you zoom out and look at how money moves through policy, cash flow, and public sentiment, it becomes clear this isn't just a rebound, it's a reshuffling. ETF showdown, from risky to revolutionary. All right, let's put names to strategies. There's a reason ETFs are so popular with everyday investors. That they're easy, diversified, and feel safe. But in 2025, diversified doesn't always mean positioned. And that difference is everything. Let's start with JEPI, the income darling. It sounds good on paper. High yield, monthly payouts, big name holdings like Microsoft and Visa. But dig deeper and you'll see a flaw nobody's talking about. Only 3% exposure to energy. In a market that just crowned energy king, that's like showing up to a gold rush with a plastic spoon. Not only that, JEPI's strategy depends on market volatility. But Trump's bill brings policy clarity, which reduces volatility. That's a double whammy to its option writing income model. Next up, DGRO, the growth-minded dividend fund. It's got solid exposure to financials and tech, and yes, companies like Microsoft and Apple benefit from R&D deductions. But again, only 5.2% in energy. Not bad, but far from goldmine territory. It's like showing up late to the buffet, the best seats are already taken. Then there's VYM, the classic broad value play. Solid, reliable, and diversified. It holds 8% in energy, more than most. Financials and tech are in place, but it also has dead weight like utilities, which are facing serious headwinds. It's good, but not great. It plays not to lose. And then there's SCHD. This ETF didn't just have exposure, it doubled down. 19.4% in energy, perfectly timed before the bill passed. Not only Chevron and ConocoPhillips, but companies with free cash flow, fortress balance sheets, and dividend reliability. And it gets better. SCHD rebalanced in March 2025 before the bill became public. That's not just smart investing, that's predictive positioning. Add to that strong positions in industrials, payment processors, and healthcare giants that benefit from the bill's drug pricing neutrality. And you have a portfolio perfectly aligned with the three biggest forces in finance: policy, profit, and people. This wasn't luck. It was strategic, data-driven, and laser-focused on what matters most now: where capital is going next. And that brings us to the real question: what this means for you, and why most will miss it. Let's get real for a minute. The average investor? They'll hear about this bill, maybe even nod along to CNBC, but they won't act. They'll stick to the same ETFs, the same portfolio, and tell themselves, I'm in it for the long haul. But long haul only works when you're on the right train. This isn't about panic or chasing hype. It's about understanding the map, seeing where the economy is actually headed, and aligning your investments before the masses catch on. Because the truth is, most people won't pivot. They'll miss the fact that small-cap dividend stocks are about to rise thanks to enhanced pass-through deductions. They'll miss that increased consumer spending boosts transaction-heavy firms like Visa and MasterCard. And they'll miss that while old-school dividend funds are lagging, one fund, SCHD, is quietly positioning itself to dominate. And if you're in your 30s or 40s, this timing matters more than ever. This decade is your compounding runway. Every dollar you place correctly now doesn't just grow, it accelerates. So here's what this means for you. If you're holding outdated dividend funds, it might be time to rotate. If your ETF doesn't align with the bill's policy winners, you're playing with a handicap. And if you want to build not just passive income but strategic wealth, alignment is no longer optional. This isn't about being early, it's about not being late. Because when a bill shifts the foundation of how sectors earn, expand, and pay dividends, you either adapt or you watch others accelerate while you stand still. And at Golden Goals, I want you to accelerate. Why SCHD just became the ultimate passive income play. Let's recap what we've uncovered. While the world was obsessing over tax headlines, SCHD quietly built a fortress, brick by brick, dividend by dividend, sector by sector. It didn't just hope to benefit from the 2025 Big Beautiful Bill. It positioned itself before it passed. That March rebalancing? It wasn't random. It was sharp, tactical, and now incredibly profitable. Nearly 1/5 of the fund in energy, right as energy got a $1 trillion green light. Massive exposure to industrials tied to infrastructure, defense, and modernization. Consumer staples and healthcare companies that benefit directly from increased household spending and relaxed regulations. And above all, SCHD's quality screens. They naturally favor the very things this bill amplifies: high free cash flow, sustainable dividend growth, low debt ratios. So when the policy winds changed, SCHD was already sailing with the current, not against it. And let's not forget the compound advantage here. This isn't just one macro tailwind, it's three. Higher energy profits from deregulation and demand, lower corporate taxes boosting bottom lines, accelerated infrastructure and defense spending feeding industrials. When all three converge inside a fund already built for quality and dividend growth, that's not luck, that's leverage. So no, SCHD isn't just a safe ETF. In this environment, it's strategic, it's aligned. And for long-term income-focused investors, it might be the most intelligently positioned vehicle in the entire market right now. But knowledge alone means nothing. Let's talk about what to do next. Here's where this video becomes more than just insight. It becomes a turning point, because every one of us has two choices. Keep doing what we've been doing, or align with what's actually working in the new economy. So if you're serious about building wealth through smart dividend investing, here are your next steps. 1. Audit your holdings. Look at your current ETFs. What's their energy exposure? How much of their portfolio is stuck in lagging sectors like utilities or over-leveraged tech? If you're not seeing sector alignment with this bill, that's your first red flag. 2. Compare against SCHD. Pull up SCHD's current top 10 holdings. Ask yourself, are these companies aligned with the new tax code, with energy expansion, with infrastructure upgrades? Chances are you'll see exactly why this fund is winning and why others are falling behind. 3. Think in decades, not days. The younger you are, the more this matters. Because the earlier you position your money around policy-fueled compounders, the more powerful your returns become. This isn't just about yield, it's about velocity. 4. Take ownership. Don't outsource your financial future to outdated strategies. Be proactive. Learn, question, pivot. Your freedom doesn't come from watching videos. It comes from acting on what you learn. And if this breakdown helped you see things clearer, hit that like button, subscribe to Golden Goals, and share this with someone you care about. Because the difference between financial drift and financial independence is just one good decision repeated over time. And right now, that decision might look a lot like 3 letters: SCHD.